Hey there, my name is Investor Silas, your trusted partner when it comes to investment matters. I am your money guy, your go-to friend when it comes to real talk on investing, growing your income and making your money work for you. I am also an independent financial advisor. I am a global markets enthusiast with some years of experience, which means I don't just talk, I guide great people like you to make smarter, safer, and more profitable money moves. And today, we're diving into a topic that most people think they understand. But trust me, there's a lot you're not being told. And I am talking about money market funds in Kenya. Not just what they are, but the real truth behind those flashy and amazing returns you're promised. Because here's the thing. While everyone in the financial space is talking about 10% returns in the money market and the guaranteed 10 and the guaranteed passive income, very few are actually breaking down the hidden details that determine whether you're actually growing your money in today's high inflation economy or just getting a fraction of what you expected when you put your money in the money market funds. So if you're serious about protecting your money, growing it steadily, and staying ahead of inflation, or maybe you're just saving for something important, well, let's say land, a car, fees for your children, a wedding, or just you want a place where your money can actually grow, this video is for you. Stay tuned and stay with me till the end so that you can't afford to miss what I'm going to talk about. Sit back, relax, and let's break it down the Investor Silas way. Thank you. Okay, so let's be real. You've probably heard it many more times than you can count, that you can earn 10% per year in a money market fund. Others even go further. Some claim up to 12%. Well, I've had some companies say they return 15 to 16%. Sounds like a no-brainer, right? But here's what really gets said, and what you absolutely need to understand before putting your money into any money market fund in Kenya. That 10% or 12% return you often see advertised, it's not the actual yield you walk away with. Let's strip away the marketing clause and break it down the way a smart investor would. No hype, just transparent step-by-step insight into how money market fund returns really work. And I hope by the end of this, you'll not only understand where your money is going, but how to make more informed and strategic decisions going forward. In terms of your investment, in terms of planning your money, in terms of knowing the right money market fund company to put your money in, and everything else. So I would like you to watch till the end. And the first thing I'm going to talk about is the gross yield is not what you take home. So let's say a money market fund says you'll earn 10% per year. It sounds good, right? Some even advise up to 12%. But here's what they don't always make it clear. The 10% or well, whatever they promise, it's money before any deductions or other expenses. That's like the gross return. But we have something called the net return. So let's break it down. We have a 10% gross return being given by a money market fund. Let's call it money market fund A. Now we have something called a withholding tax. That's the tax on the interest you earn on the amount you will invest, which is actually 15% in the Kenyan standards. Now, you have to take off that 15% withholding tax on the 10% interest rate given by the money market fund. We'll first do a 15% of the 10%, which is roughly 1.5%. Then we subtract that 1.5% from the 10%. So what will you be left with? You'll actually be left with 8.5%. So what does it mean? That 10% you're being given by the money market fund, after accounting for the taxes, it actually goes to 8.5%. Next, it does not just end there. We also have another important fee. So there's something called a management fee. And this is what a company managing a money market fund charges for handling your money, researching investment opportunities, buying treasury bills, tracking performance, thus making your fund run smoothly and thus making money for you. Most money market funds in Kenya actually charge a management fee of between 1% and 2% of your total interest per year. So let's use 1.5% as the average in this example. Remember, previously we had subtracted a 15% withholding tax from our 10% and we made with an 8.5% interest. Now, let's also account for the management fee, which will be 1.5% what we're going to use in our case, from the 8.5%. So we're going to remain with something like a 7% actual return. So what does that mean? The 10% quickly advertised by the money market fund becomes something like 7% when it's all said and done. And that's why it is very important to do the mathematics first before you put your money anywhere. You have to calculate what you actually earn, not what they advertise. And wait, it doesn't actually end there. I've got more you really need to know, because understanding just the tax and the fees is only half the picture. There are other hidden truths and small print details that most people completely miss, and it could actually cost you in the long run. So let's keep going, because the next part is a game changer. And what am I talking about? Inflation. This is another important thing you have to consider when you're putting your money in a money market fund. And why does it really matter? So I want you to listen carefully, and probably you can get some insights from this. Inflation is the silent thief that actually eats away at your money's value every single day. It doesn't scream or crash the markets, it just quietly reduces your purchasing power over time. So as of late 2024, Kenya's inflation rate hovered at around 4.1%. And that was according to the Central Bank and Consumer Price Index. But by February 2025, it had eased slightly to about 3.5%, which was a good news as compared to the political and economic scene in the country, but still significant when it comes to the real returns on your investment. So you have to put this under consideration. I want us to do the maths that most people skip, but real investors keep this in their mind. Let's say your money market fund gives you a gross return of 10%. After deducting the management fees and everything else, you are left with something like 7% as you've done before. But here's something called the economic truth. That 7% isn't fully yours in terms of real value. When you subtract the inflation rate, let's say the 2024 figure of 4.1% for a conservative estimate, your actual gain in purchasing power is only about 2.9%. And that's the key insight. It's not just about how much your money grows, but it's also about how much value it retains in the real world. So, am I trying to discourage you? No. I'm just trying to open up your eyes so that you can think like this strategic long-term investor. Why? Because inflation is actually cutting into your returns whether you like it or not, and shrinking the buying power of your money. Take an example, the 1,000 shillings of 2000 or 1999 is not the same 1,000 shillings of 2025. Actually, many people make a joke that in 2025, 1,000 shillings is like 100 shillings. And because of that, any serious investor must consider inflation when calculating your real returns. You can't just look at the interest rates alone. You have to see how much you're actually gaining after inflation eats away at your money's value. So don't get me wrong. I'm not saying this to discourage you, as I've said. Money market funds, in fact, are one of the better options out there for a steady, relative safe growth. I want you to consider this. Your typical bank savings account might actually give you 2 to 3%. And the normal M-Pesa savings, or those people who put their money in M-Pesa, does it really grow? No, barely anything. Just remains the same. So meaning your money even loses more value when you place in such baskets. But the money market fund doesn't pay you interest. They doesn't only pay you interest. That's what I'm trying to mean. They also help your money keep up with the rising inflation and the rising prices, and even grow beyond the rising prices. So the higher the interest rate of the money market fund company you choose, the better your chance of beating inflation and actually growing your purchasing power over time. So you better choose a good money market fund firm, because you'll be keeping up and you'll also be winning in this inflation game. And let me also tell you another important thing, which is the yields of the money market fund. There is one thing that has to be made clear about this. The yields are not always constant. The rates are not fixed. They actually fluctuate. Right now, in Kenya, most money market funds offer annual returns of about 8 to 11%, while some top performing funds occasionally hitting around 12%. However, these numbers aren't fixed. They change regularly based on market conditions. What does that mean? If a company say that it returned maybe this that time, does not mean that it will return that in future. It can even be lower than that or higher than that. And the percentage, as I've said, is not a guaranteed return. Why? Because money market funds or MMFs mainly invest in short-term government securities like the treasury bills, also called the T-bills. And because of this, their yields depend heavily on few key factors like the current treasury bills interest rates, the inflation rates, the policy set by the Central Bank of Kenya, and the broader market demand and liquidity conditions. So, what does it mean for your returns? Like, I have to make it clear. When the interest rates go up, money market funds returns generally rise too. Since the new government securities, these funds buy into, or rather the funds, because they take our money and they invest in the government securities. So the government securities also pay them a higher interest. But if the Central Bank of Kenya cuts the rates off, or if the inflation starts to fall off, then the money market fund yields tend to drop because the underlying investments are generating lower returns. So let me just give you an update. Kenya as a country has seen a notable decline in interest rates recently, especially impacting money market funds. This drop ties directly to inflation trends. Inflation, in a nutshell, tells us how fast prices for goods and services are rising, and it affects how much investors expect to earn. When the inflation is actually high, investors demand higher interest rates to protect their real returns. For example, in 2022, the Kenya's inflation rose to above 7.5%, which was higher than the central bank's target. It pushed the interest rates up, and by March 2023, the inflation rates peaked to about 9.2%, which kept the rates of the money market funds yield increased. Why? Because there were high interest rates due to high inflations. But as of 2024 and by February 2025, the inflation rates have dropped to around 3.5%. And with the lower inflation, the central bank has been able to reduce the interest rates. And this means that the money market fund yields have become lower compared to the high seen just a couple of years ago. So don't be surprised or don't be unhappy when you see that right now the rates are a bit lower than how it was before. Just take into consideration that money market fund interest rates are not constant, they actually fluctuate. And furthermore, here is also another thing, most important thing that many people don't mention about in the money market funds, the withdrawal process. You see, money market funds are generally liquid, meaning you can actually get your money whenever you need it. But this is not always instant like M-Pesa. In many occasions, most funds let you withdraw for free once a month, and after that, you might actually pay a small fee if you keep on withdrawing. And in some funds, withdrawals usually take 2 to 3 business days if you want the money in your bank account. So, when you have an emergency and you need an instant cash, it can actually be a challenge, it can actually be a barrier. And if you plan to use your money market fund money more frequently, then plan your withdrawals carefully to avoid these fees and delays. This little detail can actually save someone some more cash and frustration because the fees actually eat up into your interest on the money. And also, another thing is that if you're constantly withdrawing or topping up small amounts in your money market fund account, the power of compounding barely works. To really benefit from this money market space and any other investment basket, you need to keep your money steady so that it can grow day by day. You actually need to invest and reinvest the interest. I want to think of it like planting a tree and watering the tree. And the longer the tree stays in the ground and the longer it is more watered, the deeper the roots become and the bigger the harvest. So, this is for today's episode, and I hope you have had some real clarity and confidence when you're now approaching the money market fund matter with more information and more education. If this has helped you, give it a like, hit a thumbs up, share it with someone who needs to hear this, someone who's been interested in the money market fund space but is a bit skeptical and he doesn't know a few things. This can actually be of help to him. And subscribe to more real, relatable, and financially smart content. And if you're new to the money market fund investing, this is also for you. You can learn a few things here. And I always reply every comment. So don't forget to comment if you have liked the video. If you want me to talk about any other thing, you can comment over there. And for the next video, please don't miss. I'll show you how to make the most out of a money market fund and avoid the traps that hold people back. This means I'm going to give you a certain formula that when you use and you invest your money in the money market fund, you're actually going to have some very good returns at the end. And thank you for watching. This is Investor Silas, your trusted partner in smart investing.